Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Dean Tenerelli of T. Rowe Price. Hi, Dean.
Morning, Emma.
So you run a European equities fund and we're going to talk about China. It may not seem connected, but the Eurozone imports a lot of growth from China in one way or another. And we've just had growth figures from Germany saying that they achieved 0.4% growth, GDP growth, which doesn't seem like much. And it does beg the question, is there enough growth in the bag that China won't knock the Eurozone off course?
It's a very good question, and China is very important to the world, to Europe, to the US, and everywhere, particularly to Europe. Europe is a big trading partner with China, and particularly Germany is a big trading partner with China. So, and we are very concerned about China. China clearly is decelerating. Recent GDP prints have been lackluster. Other indicators are coming out even weaker, so there is a good chance that we're not even reaching the GDP prints that China is showing. And clearly their policy action is showing you that also the Chinese government is concerned. And the recent move to allow the currency to depreciate is yet another move to, one, liberalize the currency, but also to help to bolster exports, which have been weak. So if, you know, and we've been saying this for the last year, our biggest worry right now in the world is China. It is not Europe. I do feel, though, that the earnings recovery in Europe is well underpinned. I'll give you some figures. The recent earnings season in Europe has been the best earnings season that we've had since 2010. Net beat misses by 15%, which is the highest number we've seen, again, since 2010. And most of that came from the European portion of earnings within European companies. And GDP growth will accelerate next year. And you have countries like Ireland, which are almost hitting 4% probably next year. You have Spain hitting probably 3% next year. So you have very good GDP recovery. And the other thing to remember is that Europe is still well below the peak GDP of 2007. And the earnings are about 25% still depressed from 2007. Basically, we haven't recovered yet. So even within Europe, we feel this recovery. Now, can China drag this down? It could. It could make it slower, but I think as far as the recovery goes, it's well underpinned and we're moving in the right direction. Will it be slightly slower? It could be. It could be.
And that's the impact on the economy, but of course you're a stock picker. So what is the impact on stocks, if at all? Presumably it's those companies that do have revenues in the Asia region, in China, that will be most affected.
They are, and there are certain companies or sectors which have more exposure than others. And so the key sectors which would be most affected would be industrials, obviously, or luxury goods, consumer staples companies. But, you know, many companies have a portion of their earnings coming from China, and that typically is 5 to 10%, but in some companies could be 30%. As the dilemma, not a dilemma, but it's a dilemma or an opportunity, which is those stocks which have sold off because of China's slowing, where valuation proves interesting, and earnings momentum isn't great, and we're still seeing downgrades. Are they worth buying yet or not? And in some cases, I feel that they are, and we've taken positions in Swatch Group, for example, so the luxury sector, which has been hit. We've kind of bought into that slowly, but Swatch is very cheap. It works very well in our DCF, and momentum isn't great yet, but buying at this price and holding it, I think you're going to make money. Another example will be a fantastic company called Dürr, which is an industrial which is exposed to China and to the auto sector. And auto sector is one of the sectors, another sector which has been hit by the Chinese slowdown because it's been a great source of growth for the European auto companies. And we've recently taken a position in Dürr, which they make robots to paint cars, basically, and they do a bunch of other things, but that's half of what they do. And the stock has been hit, and it's a fantastic business, 30% return on capital employed. They recently made an acquisition. They're going to increase the returns up to 35%. So there's a great underlying micro story at the company that's been dragged down by the China worries. So China's providing what we think are opportunities, but again, you can't jump fully in without really keeping an eye on what's going on with the macro in China, because it's not without risk, let's say.
European stocks are popular, though, despite the fact that we've had rumblings from Greece that what feels like forevermore. If you just look at where US investors are putting their money, we've recently had figures from the second quarter of this year. It seems that US investors are not actually favouring homegrown stocks, despite the fact that it's had such a significant rally in the US. They're looking to Europe, and that's where they're putting their money because they think that there are better opportunities to be had. I suppose the flip of that is if you were a contrarian investor, you wouldn't want to go with the crowd, or have US private investors got it right?
I think they have got it right, especially if you're looking through a U.S. lens. The dollar is very strong now. One, the euro is very weak now. Two, Europe is still recovering. It's a lot behind the U.S. as far as earnings recovery goes, and as I mentioned, we're still well below peak. The U.S. is about 30% above the 2007 EPS level. So clearly the U.S. has recovered, has done well. The market is trading much more expensively. On a cyclically adjusted basis, Europe is much cheaper. It's well below its long-term average, and the currency is undervalued. So I think Europe continues to be a great region of opportunity in the world.
Dean, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.